here at the research department. And we have Malhar Nabar, who's Deputy Chief of the World Economic Studies Division, also at the IMS Research Department, and happens to be lead author of the report. Thank you guys so much for joining me, and I'm excited to discuss it. So, Gian Maria, if we could start with you, talk a little bit about the motivation for this study, and in particular, the context that you thought you could add to this barrage of 10th anniversary material that we've all been writing and reading about.
Thank you, Pedro, and good morning, everyone. This was a truly global crisis, and as you highlighted, there has been a lot of soul-searching on its main causes and why did we get there. The focus of the chapter is mostly on how countries around the world were affected and why. And we think that is very important because you want to draw lessons on trying to avoid a repeat of this type of event. And if you're a smaller country and have little say in what happens in the global economy, you want to make sure that you are in a condition to withstand external events to a good extent. One main question is whether you are hit hard by the crisis because of external factors. Simply, you happen to trade a lot with the countries that are at the epicenter of the crisis, bad luck, or whether there are some domestic features of your economy which have made you particularly vulnerable to the shock. Say you were reliant on a lot of financial flows from the rest of the world, you had very fast credit growth and overheated economy, or features of this type. Another key question the chapter seeks to provide an answer to is what can you do about it? What have countries done about it? And has that helped in mitigating the impact of the crisis? And of course, the final important question is, where do we stand now? How does the world outlook compare to what we could have expected based on the trends that were in place before the crisis?
Sure.
That is really the scope of this chapter.
Great. And also, before I get to my next question, I wanted to encourage our online viewers to submit their questions, and I'll be receiving them here as they come in, and we'll take them towards the end of our discussion. And so, Malhar, if you could talk a little bit about your findings. What did you find that was unique and maybe different than what you expected going in?
Well, thank you, Pedro, and good morning, everyone. As Gian Maria mentioned, the focus of this chapter was to try and understand the extent of damages across countries, the channels through which these damages spread across the world, and also to try and understand what policies helped both in the lead up to the crisis to protect countries from harm, but also in the aftermath to help them recover. In terms of the damages, there are several layers to this. In the first instance, there are many countries, even today, that are operating below pre-crisis trends.
Yeah.
And what's interesting is not just the countries that suffered banking crises in 2007, 2008, but also other countries outside of that epicenter that were affected through trade links or through financial links that are still operating at levels below pre-crisis trends. Beyond that layer, there's also possible long-lasting effects of the crisis on potential growth. And we see this through lower birth rates, lower fertility in the worst affected countries, and that's going to have an impact on labor input going forward. We also see that in countries that were hit hardest by the crisis, there seems to be some evidence of slower technology adoption, and this is, of course, going to affect productivity growth and potential growth going forward. And interestingly, we also see that countries that were hit harder by the crisis were also countries where inequality increased to a greater extent. And some of these trends were already in place prior to the crisis, but it seems that the crisis has reinforced some of these developments. In terms of policies, against this backdrop of widely shared losses, deep losses, and long-lasting effects, we see that policies at the national level, both in the lead up to the crisis and after the crisis, together with multilateral efforts, did help countries in the aftermath, and there was variation in how countries performed, and policy seems to have played a role in determining the individual outcomes.
Sure. So from that, would you would you suggest that as far as policy recommendations for the future, because I felt reading the chapter there was both really depressing because as you mentioned, it seems like we've gone through this very dramatic event that, we're not going to recover from quite in the way that we could have imagined beforehand. But at the same time, the optimistic part is that there's, countries' hands don't completely seem tied, that there is some action that they might be able to take. So what are some of those
Sure. I mean,
key factors?
What's interesting is that this was the most catastrophic economic event in 7 decades since the Great Depression in terms of its global scope. But what's interesting is that even against that backdrop, there were policy actions that we were able to zero in on in the chapter that seem to have helped limit the harm and helped countries recover. There are 3 interrelated categories. The first is, if you look at countries in the lead up to the crisis, the places where financial vulnerabilities had accumulated to a larger extent. And these are financial vulnerabilities, the symptoms of which are seen in rapid credit growth or in excess external imbalances, excess current account deficits. These were the countries that suffered larger losses in the aftermath. And that suggests that there is a role for macroprudential policies and effective supervision to contain these vulnerabilities. And this could be a way in which countries going forward in the lead up to potential difficulties going forward, that this could be a line of defense for them. Beyond the financial sector policies, we also see that demand support, places where there was room to deploy fiscal policy and lift demand. These were places that suffered smaller damages in the aftermath. Monetary policy, the unconventional actions that many advanced economy central banks took also helped complement that fiscal support that was provided. We also see that some of the exceptional actions, unprecedented actions that were taken in the aftermath to support the financial sector, for example, capital injections, the guarantees that were provided to banking sector liabilities, these seem to have helped mitigate some of the losses because they, in a sense, they helped thaw credit markets and helped with the resumption of credit services. Beyond all of this is also the role of policy frameworks. We find, for example, that countries with more flexible exchange rates seem to have suffered smaller losses. The exchange rate seems to have played a buffering role to help with the adjustment in the aftermath of the crisis. So all in all, when you put all these things together, it does suggest that yes, there were these big forces that were acting on individual countries, but domestic policy settings did help. I also want to mention that complementing this, there was an unprecedented multilateral effort. The fund was a central part of this as well. The fund was very early in advocating for a coordinated fiscal stimulus in the lead up to the November 2008 G20 summit. The fund also expanded its lending resources. It expanded the unconditional liquidity support that it provided countries through a general allocation of our special drawing rights, which are claims on the fund's freely usable currencies. And beyond these actions, there was also the role that the fund played, working with other standard setters in helping with the regulatory reform. And you'll be talking to my colleagues from the GFSR on this in a few minutes. So many different ways in which the fund played a role, but crucially, multilateral cooperation was a big part of this policy response and helped the global economy prevent an even worse outcome than might have occurred.
And there's been, if I could turn this question to you, there's been this great debate, both within the fiscal policy world and the monetary policy world, about the nature of the global response and whether it was sufficient and timely. And there seems to be this, the general assessment seems to be that once, at least developed country central banks, they might have lagged a little bit in realizing the magnitude of the crisis, but once they saw what was coming, they reacted fairly swiftly. Do you guys get a sense that more could have been done to prevent, that we could have gotten out of this better, or was the policy response kind of commensurate with the economic hit that was taken?
I think you're right. Policymakers, all the observers learned as we went along. The extent and duration of the losses were a surprise to many. Yeah. So in that sense, next time I think we'll be, at least in terms of our understanding and knowledge, better prepared and perhaps earlier to act. There was a lot of variation across countries and regions, as you mentioned. Yeah. So it's helpful knowledge for the next recession that you have to act forcefully early on.
Yeah. And as far as macroprudential tools, like what do you guys think should be in everyone's toolkit? What are the most important tools that countries need to have up and running before they face another round of difficulties?
Well, I think I would defer to my colleagues on the GFSR because you're going to be speaking to them on this. So, but they'll probably be able to expand on that in terms of the next steps.
Fair enough. And given the fiscal hit, how much credence do you lend to the notion that there's some underlying secular stagnation happening that we just are stuck in and must grapple with, or or how much do you think there's room for a policy response that is more kind of positive and constructive that can get, is that growth potential kind of gone forever, or can it be gotten back?
Well, one thing to keep in mind when comparing pre-crisis growth patterns with what we're seeing now is that there have been some big changes in trend growth rates. And just to take two examples, in the United States, we know before the crisis had this period of high potential output growth, which was due to the IT revolution and the benefits that fed through to productivity growth from that. And that went away, but this predated the crisis. Yeah. That slowdown in potential output growth has continued, and that's something that is perhaps independent of the crisis in some respects, and that's a very important change that's taken place. China, the other large economy, these two are the two biggest in the world now. China, the other large economy, has also experienced major structural changes over the last 10 or 15 years. And China used to grow at double-digit growth rates in their very rapid catch-up phase of growth. And now they're transitioning to a safer, more sustainable, but slower growth path. So for the global economy as a whole, when you have the two largest economies transitioning in this way, it is quite difficult to expect that we'll go back to the very high growth rates that we saw before. Having said that, what we see from the analysis that we've done and others have done, the demand support policies, the financial sector repair, all of that, the comprehensive policy package that was implemented, did help lift demand and prevent even worse outcomes. Of course, that's come with some side effects. Some of those policies have had side effects. There's the buildup of vulnerabilities outside of the regulated banking sector, the erosion of fiscal buffers, with less room now to deploy in the event of a future downturn. All of these side effects need to be addressed, and the ability to respond to the next downturn depends crucially on addressing these side effects of the exceptional actions that were taken over the last 10 years.
And you mentioned inequality as a factor in the determination of who fared well and who didn't. Could one of you guys speak to, the concept of inclusive growth and what it means to have, how a more equal economy can lead to potentially greater stability in a time of crisis?
Well, in terms of the direct economic effect, if you have a situation where a large chunk of the population doesn't have the opportunity to deploy their human capital to the fullest extent possible, clearly that's lost output there, right there. If there are ways in which the access to education can be improved and these workers can find productive jobs, clearly the economy as a whole benefits. So there's a direct consequence of redistributive policies that improve access to opportunities, which then boost growth in the long run. But there's also political economy effects that make it very hard when you have a situation of widening inequality and frustration at the perception that justified by data in some senses, that the rewards are going to only a small segment of the population. That difficult political economy climate makes it very hard to pass structural reforms or other measures that are needed to boost growth. So they're both direct and indirect effects through which this trend of rising inequality can hurt growth going forward.
And before we wrap it up, is there any other final points you guys wanted to make?
Maybe on the policy response. I think one difficulty that the world faced was that actually the recovery was pretty swift early on. And I think that in some way complicated matters a bit because for many countries, policymakers thought this is the time, okay, we've done the stimulus, now is the time to consolidate. And come 2011, the situation got much more complicated than previously expected. We had a crisis in the euro area, big slowdown in growth across the advanced world. And it really showed that we were not out of the woods, that there were deeper causes that had not completely been dealt with. And I think that was clearly a complicating factor that for the policy response, that we maybe have we relaxed a bit too soon, thinking that most of the, that the job was done. And after 2011, there was a gradual recognition that this was a much more complicated transition than previously envisaged.
All right. Well, thank you guys very much for your time. We're going to take a quick break and wait for the next panel. And thank you so much.
Thank you, Pedro.
Thank you.
Thank you.
Welcome back, everyone. I'm Pedro da Costa. Welcome back to the International Monetary Fund webinar. We've just covered one key chapter of the World Economic Outlook, and now we're moving on to financial reform and the sort of banking and financial aspect of the crisis anniversary. And the second chapter is entitled Regulatory Reform, 10 Years After the Global Financial Crisis, Looking Back and Looking Forward. And it's my pleasure to introduce the panelists here. Tobias Adrian is a financial counselor and director here at the fund, at the fund's Monetary and Capital Markets Department in particular. Jim Walsh is Deputy Division Chief of the Monetary and Capital Markets Department. And Adolfo Barajas is Senior Economist also at the Monetary and Capital Markets Department. So thank you very much, you guys, for participating. And if, Tobias, we could start a little bit with the, the thought process behind the chapter and how you decided to focus on this line of research. And
yeah, so 10 years have passed since the failure of Lehman Brothers. And that failure really triggered the worst turbulences during the global financial crisis that lasted roughly between 2007 and 2009. During the financial crisis, during the later parts of the financial crisis, policymakers around the world got together in cooperation with the IMF to develop a blueprint for a regulatory reform agenda in order to make the financial system safer and reduce the likelihood of such severe financial crisis in the future. And so it's very natural now, 10 years after the Lehman failure, to take a look back and ask, what have we achieved? The G20 formulated goals of this regulatory reform agenda, which was then implemented through the FSB, the Financial Stability Board, the IMF, and the Bank of International Settlements. And so this chapter really takes a comprehensive look at what has happened, particularly in terms of capital, liquidity, and resolution in the banking sector. But we also cover the shadow banking system and other parts of the financial system.
okay, and so Adolfo, if you could speak a little bit to, I guess, what you found and how much progress you believe has been made so far.
Okay, so what I'd like to start out with is the way we tackled the problem.
Yes,
so
please.
Being a very large problem,
Yeah.
of course, it has different ways
With global
looked
dimensions,
at.
yeah.
And the way we looked at it was we wanted to focus on vulnerabilities that had built up during the run to the crisis. We know there are triggers, shocks, negative shocks that can adversely affect a financial system. But we wanted to get to the vulnerabilities that the regulatory reform we're trying to address. So our process was twofold. We wanted to look at what countries had done in the regulatory reform process, and at the same time, we wanted to take stock of movements and trends in the outcomes in the system to see if, in fact, we were moving toward a safer system, which is, as Tobias outlined, that was the goal all along. So what we can say about safety is that, particularly in the banking system, we find that the system today is safer 10 years after. There are thicker capital buffers, thicker liquidity buffers, and the capital being held by banks is of higher quality, which is something that was being aimed at. And the liquid assets that the banks are holding are also of greater quality. We also see some more mixed results. And one of them, for example, is wholesale funding, which played a very prominent role in the run-up to the crisis. Wholesale funding is still high in some jurisdictions, some of the systemic jurisdictions. It's coming down, but it's coming down very slowly. On another aspect, which has to do with too important to fail, which was also a key component, vulnerability before the crisis, we see that concentration has been stubbornly high.
Yep.
When we look at a cross-country average, we see a slight decline, but when you look at individual countries, particularly in the systemic countries, we see lots of countries where concentration
right here
has either stayed the same or increased. There are some encouraging signs that we get from both ratings and market signals about the perception of too important to fail. So in other words, do markets and ratings agencies believe that the likelihood of government bailouts has increased or decreased? And what we find is that there is a definite decrease in this belief.
Yeah.
But
that presumably is reflected in sort of downgrades that reflect less of a buffer? Is that how it works?
Well,
How do-
there's a specific
how does
there's
it-
a
how does that
specific
translate into
rating
rating?
that has to do with a
financial-
support rating
I
that
see.
has to do with
So not the bank's overall credit rating itself, but the
Exactly.
actual.
There are specific ratings, and there are differences that you can draw on that give some indication of what that likelihood, the perception of the likelihood is. And we also see that from market signals, from indicators that we can pick up. Now, all said, we say that we're safer today, but that's not in any way to conclude that the work is done.
Yeah.
The regulatory reform is a work in progress, and there's still aspects of the regulatory reform that need to be completed, and there are new risks that are arising. Just to give an idea, Tobias mentioned shadow banking. While banks overall, for a group of large countries, banks overall, their size relative to GDP has more or less stayed constant, around 220%. Shadow banking has gained ground, has gained some 30 percentage points of GDP during the same post-crisis period. So shadow banking is an area where our sights have to be very, very keen to, with risks emerging there. So overall, one message we like to...
That 30% figure is global?
It's across 29
the-
systemic economies. Okay. So it's what they call the S29.
Gotcha.
Our one main message at the end is that we call on policymakers not to fall prey to complacency and to continue this work going forward.
So I want to ask you, Jim, or whoever wants to answer, really, before we get to the shadow banking side, let's just stick to the regular stuff and the ones that did fail. There still remains an active debate about how much capital is enough capital and how much liquidity is enough liquidity. How much has that been settled, and how much risk is there still? Because it seemed like pre-crisis, one of the main risks, and I think that's where the role of the fund comes in, is that there was a lack of international coordination that led to regulatory arbitrage and so on. How far have we come in kind of leveling that playing field?
Well, one of the major successes of the post-crisis regulatory reform agenda were the new Basel III Accords on capital and liquidity. And the goal on the capital side was to improve the quality of capital, primarily through a greater focus on common equity Tier 1 capital, but also to have higher capital levels overall. So as Adolfo said, capital levels are broadly higher at banks, partly as a result of these regulations, but also partly as a result of just changes in banks' business models over time. And with liquidity, we see a similar story where we have, as part of Basel III, this is the first time that we've had an internationally agreed agenda for liquidity management among banks. And all of the jurisdictions now within the BCBS have imposed a liquidity coverage ratio that requires certain holdings of high-quality liquid assets against short-term liabilities. And as Adolfo said, this has improved the liquidity position of banks. In both cases, however, this isn't as high as we'd like, and the regulations aren't quite completed yet. On the capital side, there's still the leverage ratio outstanding. We would like countries to have rules for their banks that set ceilings on the amount of leverage overall the banks can have. And on the liquidity side, we would like banks to think in a longer-term sense about liquidity management by imposing the net stable funding ratio. But these frameworks are quite flexible, and on top of the minima that are set under the Basel Accords, countries can have higher charges, and they do impose higher charges in a number of areas, primarily in terms of surcharges on systemic banks, which now all of the global systemically important banks now have higher surcharges. GSIBs is easier to say. Across the world, they carry higher capital surcharges now. And as the credit cycle evolves, countries raise and lower the countercyclical capital buffer to reduce credit risks. So while Basel has these new minima for capital and liquidity, these are flexibly interpreted, and in a lot of cases, we are asking banks to hold significantly more capital than before the crisis.
Tobias, could we talk a little bit about the other end of the spectrum, which is the capital protects you from, makes you less vulnerable because you have equity, but if you need to be wound down, how solid is your confidence in the resolution frameworks that have been laid out internationally? Because of course it's an area that seems to be important, but yet largely untested.
Absolutely. The phase-in of the new resolution framework has happened in many countries around the world, but not all countries. Most of the countries that are hosting GSIBs, the globally systemic important banks, do have a resolution framework now. But of course, we have not seen a resolution of a GSIB yet. So the framework is in place in many countries, but we haven't tested it yet. I certainly hope that this would work well, but there are some questions about, say, the international dimensions of the resolution that remain untested.
Yeah.
We are in a better place today than we were 10 years ago, but how good it is remains to be seen.
So I want to follow up with the question that I had for the previous panel that they told me you guys could completely answer for me, which is what are the macroprudential tools that you think countries need to have handiest in their toolkit that they should be most prepared with when we hit another global speed bump of some sort? I'll leave it up to him.
Well, the most important one is one I mentioned already, the countercyclical capital buffer. Yeah. This was designed with the explicit goal of reducing the procyclical buildup of leverage in mind. And this has been triggered in a lot of countries around the world that are concerned about systemic credit risks, primarily in the EU, but also outside in a few other jurisdictions. So under the CCYB, countries raise the required level of capital for all the banks in the system, not just systemic ones. And this can be raised or lowered as the credit cycle evolves. So in quite a few cases, it's been raised, and even in other cases, it's recently been lowered when systemic risks have manifested themselves, and there's a need for to free up some capital in the system. There are other tools that are available that are quite widely used on the credit side. Countries have used tools related to loan-to-value ratios, for example, or debt service-to-income ratios to contain risks from housing markets. Those have been quite effective in controlling the risks related to mortgages in some jurisdictions. But there are also tools on the liquidity side that we have seen countries using in terms of restrictions on how banks fund themselves, or on how the extent to which mismatches can emerge within the financial system. Countries have used these for a long time on foreign currency exposures to try to reduce potential risks from mismatches from foreign currency borrowing and domestic currency lending, for example. But increasingly, these are also being used to reduce the risks related to derivatives markets and long-term borrowing abroad. So there's quite a range of tools, and ideally we would see that all jurisdictions, but especially the most systemic ones, are able to use these tools effectively and in a timely manner to contain risks around the world.
Let me just add to that many countries around the world have started to have a macroprudential policy framework that is put in place. And when we do our financial sector assessments in individual countries, we do see that there are these macroprudential approaches, but in many countries, the tools are primarily focused on banks and mortgage markets, and there is a lack of tools, say, for market-based finance in many countries. And so, there's some good news, but there is still an outstanding agenda to be completed to really get a system-wide approach for prudential policy.
I have a ton of questions about shadow banks, but I'm being told we're out of time, so I'm going to have to leave it there. Thank you very much. Thank you guys for joining, and appreciate it.
Thank you.
Thank you.
Welcome back. This is part 3 of our webinar today here at the International Monetary Fund. We're reviewing 3 chapters from 2 key analytical reports that the fund puts out. And right now we're going to be looking at the World Economic Outlook Chapter 3, which is appropriately entitled Challenges for Monetary Policy in Emerging Economies as Global Financial Conditions Normalize. Of course, we're facing a Federal Reserve and potentially a ECB that have started to normalize monetary policy, and we've already seen some of the emerging market effects. This is an especially timely topic, and I'd like to welcome my panel. Here to my left is Rudolf Bems, Senior Economist here at the Research Department, Oya Jellison, who's Chief of the World Economic Studies Division at the Research Department, and Gianmaria Milesi Ferretti, who's Deputy Director also here at the Research Department. Thank you guys for joining me. Rudolf, if we could start with the motivation for the study, and in particular, as someone who's covered the Federal Reserve, I felt that emerging markets have often complained of a sense of helplessness against the monetary forces of the major economies. So I'd be interested if you could put your motivations in that context.
Yeah, happy to take that question.
Oh, I'm sorry. Yes.
Yeah, good morning, everyone. So we've seen something quite remarkable in emerging market economies in the last several years that we would have not expected to see, say, 15 years ago. Emerging markets have experienced several episodes of financial stress, the taper tantrum, the difficulties in the second half of 2015, early 16 with capital outflows, the Chinese stock market decline, the swoon in commodity prices that pushed several economies into recession, and more recently in 2018, again, some outward capital outflow pressures and currency depreciations. But what we haven't seen in these cases, despite large currency movements, was sharp, persistent increases in inflation, which allowed central banks in many cases, not all, but in many cases, to ease monetary policy to fend off recessionary pressures. Mm-hmm. And at least prior to the early to mid-2000s, it's been well documented that central banks typically had to respond to these episodes with pro-cyclical monetary policy, with monetary policy tightening. So this new ability of central banks to use monetary policy in a less procyclical manner to help smooth out the fluctuations has certainly been a very welcome development. Now the question is, will this last going forward? And it's very relevant now because we're entering a period where the Fed will continue to tighten, the ECB will gradually start withdrawing accommodation. So it's conceivable that emerging market economies will face capital outflow pressures and further currency depreciations. It's possible.
Yeah.
So to answer that question, will this ability to run more independent monetary policy last? It's important to understand what explains this better inflation performance over the last several years. We could, for example, it could be attributable to external factors which is not under the control of emerging market economies themselves and which could reverse. For example, declining commodity prices, excess industrial capacity in some large economies, which had a tendency to put downward pressure on at least tradable prices. And more generally, the fact that monetary policy was easy in advanced economies, and even though you had episodes of volatility, there was a general tendency for capital to flow to emerging market economies. On the other hand, it's possible that this low and stable inflation that we've seen was mostly a product of domestic factors, better macroeconomic policies, stronger institutions, in which case, if central banks can continue to credibly commit to low and stable inflation, we could see these gains lasting longer. So this chapter, therefore, took stock of the recent behavior of inflation and examined its drivers.
Okay. So what did it find? What's the upshot in terms of the ability of individual countries to have some control over their own monetary policies, independent of the Fed and the ECB and the like?
Okay, yeah. So what we find is, as Oya already mentioned, so we look there's been this 1.5 decades of stable and low inflation in emerging markets. And so first we look at the drivers of, we want to understand what have been the main drivers of this stable and low inflation. And we find that the main driver is the longer term expectations about inflation in emerging markets. So what market participants think the inflation is going to be in 3-5 years down the road is what is the key for inflation outcomes in emerging markets. And we also, in a chapter, then go on and we find that that it's mostly driven by domestic factors, not the global considerations that we already mentioned as well. So domestic factors are the key in driving these. And so then we go on, since the expectations are so important, we look at something called anchoring of expectations, so how anchored expectations is. And we find that it's it's very important for expectations to be well anchored, and some emerging markets have them anchored to the level that's comparable to advanced economies, but in other countries, in other emerging markets, they are still way behind advanced economies, and there's a lot of room for further improvement. So the second big finding is the anchoring. So the extent of anchoring. There's a lot of room for improvement going forward for many emerging markets, not all, but many of them. And then beyond inflation impact, we also look at as Oya mentioned before, we look at what it means for monetary policy independence for these countries. And what we find is that it's again, it's very important for these countries. If you have monetary policy independence, they will do much better.
So, I mean, I take it that you assume within your study, you look at the progress that anchoring, the emerging markets have made from that anchoring, right? Because we're talking about many countries that had just completely runaway inflation in the 80s and 90s, and now, while they may still be high and in the double digits, they're not Zimbabwean or anything, right? Is that a fair assessment that they've made some progress from those kind of the heyday of emerging market inflation, and that we're unlikely to go back to that?
Exactly. So if the expectations are more anchored, it means that when the next adverse external development hits these economies, they will have much easier time handling it. They will have more policy space to address output, what happens to output as a result of these external shocks. And so, yeah, that's...
So I have a question for any one of you guys, which is, how did you manage to tease out the domestic effects from the international ones on a technical level, looking at, did you look at sort of nominal yields versus inflation protected ones? Is that the primary avenue, or how do you how are you able to tease that out?
So for the benchmark analysis that we do, we look at nominal. But there is supplemental material to the chapter that is, I think, now available online, where we also recast it in real terms, adjusting for inflation developments, and the findings that we have are not sensitive to whichever measure you choose.
Yeah. You try to account for, typically, if you think of a sample of emerging economies, if there is a common factor, that's more likely to be of an external nature, at least to some extent, and you can relate it to global developments, be it on inflation in advanced economies, you could relate it to what is happening to commodity prices, and then you can put in some country-specific external factor, because countries have a different mix of products, so they may be affected differently by different types of external shocks. So you try to ensure that when you explain inflation, you include these factors as potential explanatory variables, but they end up mattering in a qualitative sense, but quantitatively the main channel is really inflation expectations driven by domestic factors.
And Oya, could you speak to the institutional factors that underpin, because it seems like that is kind of a key thing, right? For central banks, institutional credibility is something that takes years to build and potentially is very easily destroyed. So could you talk about, how countries might have fared better that had deeper kind of institutional histories of central bank independence and inflation targeting frameworks that were kind of pre-existing?
That's right. The moment we found that expectations were the main factor driving inflation changes from year to year, the next step was to ask, so what helps inflation expectations to be better anchored? What are the characteristics of countries that have better anchored expectations? One factor is monetary policy independence, central bank independence, as you said. How transparently the central bank is explaining its actions, how independently it's able to take decisions. That's one key factor. Another one is fiscal policy. So people have to have fiscal faith in the fiscal outlook for expectations to be well anchored. So those two seem to play a particularly important role. And it's, as you said, it's not overnight. It's not a short-term process. It's something that's happened over time. Anything?
So how does the current, because it seems like, as you said, this is literally the paper of the three that I think is most timely, because we are facing that period of, kind of very real prospect. And it also seems like in alignment with your findings, investors are being selective about which countries are selling off and which countries are not. Could you speak about, I guess, what institutional structures and what policies could be in place that will help countries through the next crisis?
So again, it goes back to this concept of how anchored their expectations are, which ultimately is a measure of how credible the central banks are in these economies. And so anchoring is going to be the key. So if your inflation is well anchored, inflation expectations are well anchored, your central bank is credible. So even if there are some adverse external developments in these economies, you will still have that the central bank their actions are credible, and there will be exchange rate fluctuations. There will be maybe a temporary surge in inflation, but because of anchoring in the longer term, inflation, the price stability will be preserved, as opposed to countries that are less anchored. So central banks are not as credible, and then all kinds of other factors like fiscal sustainability comes into play, and then markets and market participants start to doubt what the inflation is going to be going forward, and so shock ends up being, in the longer term, it ends up being more inflationary.
Sure. Are there countries that are in the kind of wider end of the spectrum that, for instance, that may have to, I wonder if there are countries where the political risk of an appropriate policy tightening is too great, to your point about the need for faith in the fiscal side of the equation. Is there a risk that a central bank that faces kind of runaway inflation and really has to hammer down in expectations by tightening policy too aggressively could generate the kind of recession that in turn erodes faith in those institutions that you were trying to build in the first place? And is there room for kind of moving more gradually, toward a tighter framework instead of just doing a Volcker-type shock for an emerging economy that's really facing runaway inflation?
It's a good question. I mean, sometimes you have little choice. This is beyond the pure inflation realm. If you have a run on your currency and need for external finance dries up, you may be unable to do the types of things that you would like to do to offset a contraction in the economy with domestic policies. Yeah. If people don't want to buy your bonds, then the room to run, say, counter-cyclical fiscal policy disappears. Yeah. You're going to have to close the budget gap in some way or form, and when you do so, it's typically contractionary. Yeah. So there are circumstances where you're pushed with your back against the wall in which you wish you had the room to do counter-cyclical policy, but you may not have it. These are extreme cases, but I think it's important to keep in mind that this objective of anchoring expectations of stronger institutions is a super important one, because, as you said, credibility can be frittered away. And this is a key tool that allows you to respond to external conditions in a way that is more favorable to the prospects of the domestic economy. So sure, we need to worry about the short run, about exchange rate pressures, about mismatches, about many things, but you shouldn't keep out of your sight your medium-term objectives, because again, it takes time to build that credibility, and it comes very, very useful in tough times.
Okay, thank you so much, guys. I appreciate your time. Thank you so much for joining us online, and we appreciate it.